one of the most important things to learn and understand are price bars. So how is price represented graphically, visually? So you could start identifying and using indicators to make decisions. You can think of that concept of a picture is worth 1,000 words. That's the idea where price bars are going to represent things as far as what's happening with an individual stock. And there's several different types of price bars that we're going to learn all about. And they are the key building block, and some are really powerful, like the candlestick bar, which we have a whole section dedicated just to candlesticks because they're such a powerful way of representing things in a price bar. But a basic foundational price bar represents the price and is the key one to kind of start with and then grow from there. Now, traders sometimes refer to price bars as OHLC bars, which stands for open, high, low, and close. So it's pretty simple. So if we look at, let's say, this price bar on the graphic here, you can see on the left side, prices go up and down and time goes from the left to right. So further back in time is to the left, more recent to the right. But if we think of price just in the price bar aspect, you can see this like straight line up and down, and it's got two tick marks, one to the left and one to the right. If we were looking at this price bar, you can see that it has a high and a low, as will all price bars, and that's considered the trading range. So let's say this was a daily price bar. We can see that prices fluctuated between the low and the high. Now, we could also see from this price bar more information. We could see what the price was at opening. So right when the market's open, that was the first or opening price. You can see where that tick mark bar is on the left there. And on the right, you see another tick bar. That's the closing price. That's what it ended up at the end of the day. So that was the last price that was traded at the end of the trading day. And then we have the high and low, which is the trading range, the range of prices. So that's your OHLC bar. It's just open, high, low, and close. It's pretty straightforward. So now if we see a price bar opening above the previous day's close, that might be an indicator that price increase is coming. The opposite of that would be if price goes below the previous date close. That would be an indicator that price may be decreasing, or a price decrease may be coming. Now, obviously I wouldn't trade just on that. We have a lot more than that, but that's just the general idea as far as, looking at an opening versus a closing. But a lot of people don't put a lot of emphasis on where a stock opens. I'll tell you, a lot more people emphasize the closing price, and for good reason. That's the most important because it's really kind of a summary of the trader sentiment for the stock on that day. It can open at anything, but at the end of the day, after we had the highs, we had the lows, and we formed a trading range, at some point there's trader sentiment that formed and it closed. And the last price of the day was the closing price, and that's where the trader sentiment was last. And that's where a lot of people will buy and sell right towards the end of the day, or close positions, or kind of lock in on what they want to do. They're going to really just want to measure what happened throughout the day and act upon it. This is why when a lot of people are looking at prices and trends, they're generally looking at closing prices as far as using mathematics, or some of the things we'll be learning about when we're looking at averages and stuff. They typically use a closing number versus, let's say, an opening number. Now you may ask, how can we use this? If a simple price bar closes higher than yesterday's close, if they're closing high, so higher day after day, that means there's more demand for that particular stock or security, and people are willing to pay higher prices for it. And that would indicate really kind of a buying trend because the closes keep going higher. So it's a strong buy signal if the close is the high of the day, if the actual peak of the day is the actual close. If it comes real close to that high of the day in the trading range, that means that people are really buying at the peak right up to the last minute, and they want to carry it overnight. So ultimately, they just really want to get involved with the name. So that can be a real strong indicator when you have your closes near the high of the day in that trading range. Now, if the close is lower than the previous day's close, it's the opposite. You have less demand that day, and people are willing to sell, and they're willing to sell at lower prices. You have more of a selling trend versus a buying trend. So you could look at those closes as far as looking at trends. And we'll be learning how to draw chart lines and trend lines and all sorts of stuff so we can kind of graphically represent this. But that concept of higher highs is good as far as buying, and lower lows might indicate selling. And that can be represented here with different sentiments. Like, if we have, let's say, the price bar on the left, that might be considered a bearish or a downward type of sentiment where we have our normal high-low range, but you can see how the opening opened up pretty high, but then the closing was way down towards the low part of the range and the close was below the opening. That would be considered bearish or a sell signal if looking solely at a price bar. But if you look at the one on the right, you could see where it opened lower and it closed up higher. So that could be more of a bullish thing. Now with the daily OHLC bar, you also want to consider the high and the low too. What was the highest point price traded that day? And the relationship to the previous day's close and high is important as well when you're looking at a series of prices on a chart. The low is the lowest trade of the day, and you're looking at that relationship in other price bars like the opening in particular, or a lower open may mean that they may be factoring in new information or trending lower. So you're looking at that range of price bars. So the price bar can tell you quite a bit, and the trading range can tell you quite a bit too. How big is the difference between that high and low bar? Is it a small difference between the high and the low? Or is it a really long vertical line going up and there's a wide range of prices that we're being traded at? So you want to compare that in relation to other price bars that are preceding it. And you can start seeing that if there's a small range in a sea of larger ranges, then there might be some indecisiveness happening. They're trying to figure out, do we go higher? Do we go lower? Looking at that trading range. Same thing if the range is large in a sea of smaller ranges. So there's characteristics that are changing. So the bars go from small, small, small with regards to the high and low range, and then all of a sudden the range starts getting really wide, which tells us an event or something important is happening. People are trading more actively. There's a lot more interest in this particular security. It's an indication with trading range that something might be happening. And you can also link this with volume to make it even more powerful. So trading range is just looking at price, where if you combine volume with it, you're looking at the actual number of trades as well. And those two combined can give you a very strong indication. Let's look at some classic trend formations with these price bars and series of price bars that you'll be seeing all the time when trading and looking at things. And if you're taking notes, there's going to be two things in here that I'm going to mention that might be worth taking note of. And I'll tell you when I share them so you don't have to try to guess on that. But there's two big overriding concepts that are coming up that I think are very important. If we look at a classic trend formation of the price bar series, we're looking at price bars that have formed over a period of time. So if you're looking at a series and they tend to be, let's say, uptrending, so the highs are higher, you have higher highs, meaning each day the high is getting higher than the day before, that's telling you something. So if your highs are higher and the lows are higher, it's giving you a signal of a strong uptrend. And if you feel that that trend is going to continue, you might want to buy in and enjoy that uptrend and ride that uptrend until it's time to sell. And you could enjoy a price increase and profit from that. By the same token, a downtrend would be lower lows, right? You're looking at the lows and are they going lower? Is the low today lower than yesterday or lower over the past few days when looking at that trend? And again, if the highs are actually lower, so the highs and the lows keep trending lower, that's a strong indication that everything's going lower. And it's really that perfect. Oftentimes you have ups and downs and all that and pullbacks and things that happen within the trend, but you got to be looking for this overall trend where things are happening. And one of the key things, and this would be the first thing to maybe take note on, is you want to wait for the trend to develop. Where people really struggle is they might think, they'll say to themselves, I think a trend's developing, but they haven't really proven it yet, or they haven't really shown that from a technical analysis standpoint, and they just jump in prematurely. You need to let the trend develop a little bit. So it's a real trend and not just kind of a fake where it's going to go the opposite way. The way to lose money while using technical analysis is to kind of guess at things before they've actually developed, like it's some kind of game. You want to let things develop. You want to have trends develop. It's not a casino. We're not gambling. So that's the key takeaway. Let's let the trend develop, and we'll learn how to draw trend lines and stuff like that. We have a whole section on chart patterns. But right now, higher highs are uptrends, lower lows are downtrends. It's the classic way to look at it. And you can kind of see that graphically here. So if you see on the left here, the uptrend graphic, you could see how the tick marks on the right hand side, which represent the closing prices, you can see how on the right hand side of each bar, those closing prices keep going up. That's showing a definite uptrend because they keep going up. In fact, even the lows look like they're going up too. So this is a strong uptrend with higher highs and lows. Same thing with the downtrend graphic on the right. You can see how the closing tick marks are lower lows. So on the right hand side of each bar, how that tick on the right keeps forming lower and lower as the days go on progressively. So that's representing a downward trend. If we're to look at things on a broader price chart, and we'll be doing things like this throughout, this happens to be a chart of technology-based stock Apple. I thought it would be beneficial to kind of show an example from a real chart. And I highlighted two areas. The first being our uptrend, where the bars start to turn going upward, giving us those higher highs, which are necessary to categorize within an uptrend. And then price began to falter at the top, and you start to see it put in lower lows, giving us kind of a mini downtrend, which small downtrends do often occur within strong uptrends, but we'll address that at a later time. Just want to kind of show you, an uptrend and a downtrend in an actual chart. But the second thing I think you want to take note on is not only wait for the trend to develop, but also understand that the trend is your friend. It's probably the most classic, overused thing that's ever said in technical analysis. The trend is your friend, but that's for a good reason, because the idea of the trend is that it gives you some prediction capability. When you have those strong uptrends, you can kind of predict that it will continue and then identify when that trend might be over. So the trend is your friend. Look for trends. You want to befriend trends for sure. And that's the key part of a lot of technical analysis. It's identifying trends and making decisions around that. And when you get really good, you could kind of identify characteristics within those trends and stuff like that around that can help you identify if it's going to be a more reliable trend or not. So remember, the trend is your friend, but you also got to let your friend develop. So let your trend become clear and develop, and we'll be showing you how to do that in upcoming lessons. Let's talk a little bit more about how we could use the trading range as a technical analysis tool when we're evaluating what might be going on there. And as we know, the range is the distance between the low and the high of a price. So let's look at some different ways we could use trading ranges to kind of get a better understanding of it. And it can be a leading indicator as far as a price change that is coming. So when we start to see these ranges between the high and low expanding or contracting, that might be telling us that there's something coming. That's what we call a leading indicator versus something that may be more of a lagging indicator. So it could be very helpful that way as well. So if we look at trading ranges, we could look at range expansion and range contraction. So if we look at these examples here on the left, we have range expansion. You can see that the price bars are lengthening over time. You could look from going from the left to the right, how they tend to be lengthening. And that would suggest the continuation of the trend or a continuation pattern as far as, if it's expanding, that whichever way it's going, it could be up or it could be down, whatever way the trend is moving at that time. If we look at range contraction, that's where the price bars are shortening over time. And you could see from the left to the right, on the right-hand image there, how the bars are getting much, much shorter. And that suggests a trend reversal may be coming up soon. So as well as using the other indicators we're going to learn all through the course, you start looking at how the price bars themselves are acting. Are they expanding or contracting, to kind of figure out if a continuation or a trend reversal might be indicated by the patterns within the price bars, or being formed by the price bar. So range expansion and contraction don't tell us anything about the existing direction of price action move, just more so whether the trend would continue or that it might reverse, because it could go either way depending on whether they are contracting or expanding. But the range can expand or contract in both upwards and downtrends. So they can do it both ways, but it's more range expansion speaks to a continuing trend in the same direction, whereas a range contraction might show a trend reversal or basically flattening out or changing of the trend. That's the big idea behind that. In addition to looking at trading ranges and how they could be indicating continuation of a trend or the reversal of the trend, there are additional ways that we can kind of add confirmation to that. So let's take a look at some of these important ways that we can do that. A very important thing to look at is volume. And volume can be either rising or falling. It's basically looking at how many transactions, how many trades are happening. Is that going up or is that going down? So rising volume would indicate new people are trading the stock, or maybe existing traders are just adding to their allocation, a position they already have. So it's not just new people coming, it might be existing people buying more, and that tends to accompany a range expansion and really accelerates a trend. So as volume rises, that will tend to keep that trend going in that direction and really expand on it. If you happen to see an expansion of a range, wider range, but it lacks in volume, then you could kind of have like a mystery. There's really not any specific indication. And then you need to look at other indicators like in our momentum section of the course and use them to kind of confirm what's been going on. But the idea is if it's rising, it's going to accelerate the trend. Now, if volume is shrinking, that means fewer people are in the market for that particular security, or existing traders are reducing their allocation, getting out of it. And falling volume often accompanies a range contraction where the width between the range and the high and the low, might be contracting. Another thing you can kind of look at in terms of trading range with regards to confirmations is around the open and close position. There's really 4 combinations. You can have an expanding range, so the price from the high to low is expanding and closes are getting higher. So there's higher closes, and that tends to indicate the buyers are thinking the price is going to continue going higher. Now, if the range is expanding but the closes are getting lower, then sellers are getting a little bit more anxious and maybe want to unload that stock. By the same token, you can look at a contracting range and high and low. So in a contracting range, so getting narrower, not as big of width between the low and the high, but there is higher closes in the contracting range, then it might be indicating that investors are feeling uneasy about the direction the security has been trending. And the higher close can offset some of that negative sentiment of the contracting range. So there might be a little bit of uneasy feeling and the range is contracting, but there might not be necessarily a reversal. They're kind of just offsetting a little bit here. If the range is contracting and the closes are lower, well, that's kind of like a double negative for an existing trend. Traders are selling at a lower close, so they're willing to take lower prices, and also the range is contracting as well, too. So maybe they're really just trying to unload the security and kind of get out of it. So these are examples of where high volume and a lower close in a contracting range, when you combine the 2 variables, so the contracting range with the high volume, it could be a real big sell confirmation. High volume indicates that there's a lot more strength to whichever way the direction is headed, and lower close within a contracting range shows the prices are going down. So combining the 2 variables together could really demonstrate how powerful that combination can be. So there are some other additional things to look for when you're looking at like prices and ranges and what might be happening, whether they're expanding, contracting with volume, and what might be going with expanding range and higher closes or lower closes. Linking all those things together in addition to other tools. So we're going to kind of layer on top of that. A trading range can also give you a feel for anticipated price gains and price losses in terms of, let's say your own profits from trading in this particular security. And you can think of the terms of the range in terms of amounts. What is the difference between them? So if we use, let's say on day 1, something had a high of $10 and had a low of $8, well, we would say it would have a $2 trading range, right? 10 minus 8. Very, very simple. So they will give you an idea of potential profit around there. So if we look at this example even closer, let's say over 5 days, you have these different price trading ranges. Now, these are not the actual prices. This is the range. Like the previous example showed, we had a $2 range. Maybe day 2 was $3, then $1, $4, and then $2. So over 5 days, you have this total range and effect of $12. And you divide that by 5 days and you get your average daily trading range of $2.40, right? Simple math at that point. Again, that price in this example, we're looking at the trading range as a technical indicator and maybe as a profit anticipator. So we have $2.40. So let's say over that daily range, the $2.40, then if you have bought at the absolute low in this particular example, over those days of trading, then you saw at the absolute high, then you would have made $2.40 per share of security that you had for that particular day. Now, is that, common to buy the absolute low and sell at the absolute high? No, not at all. But you might be near each of those extremes, and it kind of gives you a general feel for what your potential profits could be. So if a stock has a high trading range and you're buying maybe near the low, you have more of an opportunity for profit than if you were to buy at the low of a more narrow, smaller trading range. So setups with higher ranges might give you more opportunities, but you have to look at so many other things as well. But trading range can give you an idea of a lot of things you could look at from a technical analysis standpoint.